Welcome back. Today we're talking about the free UK stocks to buy in November 2020. One of these stocks I have personally bought myself, and so if you find this video useful, then please drop me one of these to support the channel. The first stock on the list is a company I would believe that would benefit if a second wave were to occur. To me, the odds are looking more and more likely with cases spiking up, although understandably the deaths are staying comparatively lower to the last peak. But I do think it is inevitable, so therefore I would be looking for an adequate hedge to invest in so that when a lot of these stocks drop, this company will actually benefit from this. And I believe that this stock will see increased footfall in the opportunity or chance of a second national lockdown to happen. This stock engages in the retail of homewares in the United Kingdom, has a market capitalisation of £2.9 billion and 9,800 employees. The stock ticker is DNLM, or more commonly known as Dunelm Group PLC. To start, I like to look at how the market values a company, and the first thing I look at is the price to earnings ratio, in which we can see this is considerably higher than its industry and also the market. This tells me that investors are fairly bullish on the company, but also that perhaps they've had weakened earnings as of late. Basically, what I think is that investors are more happy or more satisfied buying shares of this company, even if they're getting less earnings per each of their purchases. Furthermore, this is backed up by their ridiculously high price to book ratio, which supports this case and tells me that investor sentiment in the stock is fairly high. Or it could also tell me that they either have depreciating assets, not a lot of assets, or a lot of debt in their balance sheet. Regardless, I'm more interested in their growth potential, and in the last 5 years, they've managed to grow their earnings by a compound annual growth rate of 0.1%. However, this is mainly due to a negative earnings trend in which in the last half a year, especially when the pandemic is hit, their earnings have declined by 13.3%. On the other hand, Dunelm has higher than average profit margins, a high return on capital employed, and a high return on equity. This tells me they may not be a growth stock as they're not consistently growing their earnings and not really growing their revenue, but what they are doing is being highly profitable and generating lots of cash and cash flow. Therefore, I feel this is more primed towards dividend investors. However, they had cut and suspended their dividend during the pandemic earlier this year and then also chose not to resume it furthermore. I do suspect that this dividend will be resumed in the next financial year, so 2021 onwards. However, for the time being, you will not be receiving any dividend income. It's a shame really, because this was a consistent dividend payer that had managed to keep paying a dividend since 2007 and grown it every single year. This at least suggests to me that once they do eventually resume their dividend, that this would be one of those reliable, more defensive dividend paying stocks that you could rely on in times of crisis. Obviously, a pandemic is a whole other level of a crisis, so it's understandable why they had cut and suspended this, but at least in future it has that opportunity behind it. They've also regularly paid special dividends, which gives me the idea that perhaps they regularly distribute surplus cash to investors, and then that would actually explain why they have a much higher price to book ratio, simply because their net assets are decreasing because they're regularly distributing cash. Regardless, this could be a cyclical stock, but one that can weather the storm fairly well. So if you feel that Dunelm could reverse its negative earnings trend and likely outperform others in the industry, then this would likely be a good medium to long-term opportunity. Although I suspect the weakness with this stock is the quality of their balance sheet, in which their short-term assets only marginally cover their short-term liabilities and do not cover their long-term liabilities. On the flip side, they do have what to be considered as a low debt to equity ratio, which they are steadily reducing, and this is combined with a fairly impressive cash position of £90 million. Whilst approaching their all-time highs, I very much suspect that this is still a high, medium to long-term opportunity. Perhaps in the short term it might decline over the next year, but if you're able to steadily even build a position, consistently top it up, then likely over that longer time period that you will start to outperform, especially once the dividends are added back into the company. If you'd have held Dunelm in the last 5 years, you would have gotten returns of 95% with dividends reinvested, which outperforms our quite weak market of 16.4%. And if you're interested in grabbing one of these stocks selected on the list, then sign up to Trading212 using my link in the description down below to get a free share worth up to £100. The next stock may be quite a surprise to some of you that regularly keep up with the channel, and that's likely because I have spoken about it as of recently and perhaps not given a very bullish outlook on it. Regardless, I have been buying this in the last month, and therefore I do think it is valid for me to add this to the list. And I believe that with this stock we are starting to see a reduction in investor sentiment, so that could mean an opportunity to buy. This company actively engages in financial market infrastructure in the UK, US, Italy, France, and internationally. Currently, they are undergoing a huge potential acquisition which could reform the whole business, change the business model, and further increase their growth potential. So therefore, it's priced up very highly and may intimidate a value investor that looks for only low price to earnings ratios. This stock has a market capitalization of £29.6 billion, 5,000 employees, and is named London Stock Exchange Group. As I mentioned earlier, if you're a value investor that only looks for low price to earnings ratio companies, then London Stock Exchange Group will not be a good fit for you. This is because it's currently trading at a price to earnings ratio of over 74 times. It is way higher than the industry and the market, which suggests to me that investor sentiment is very high, but also this could be priced up higher because of speculation over the Refinitiv acquisition, which may be complete soon. When we combine this with their price to book ratio of 7.9 times, it certainly gives the appearance of looking overvalued. However, I prefer this as I feel that investor sentiment is therefore higher, people are more bullish on the outlook of the company, and it's generally a positive signal. If investors are more willing to pay a premium for less earnings of a company, it really reinforces how the quality of this company is and makes me look more favourably upon it. What I really like about LSE though is their growth potential. In the last 5 years, they've managed to grow their earnings by a compound annual growth rate of 17.5%. Already quite impressive. Then when we factor in the idea that this Refinitiv acquisition could seriously change up their business model and structure and therefore increase their cash generative business, it does certainly look like a high growth potential stock for the future. And looking at stats like return on assets just won't give this stock justice, simply because they have so many assets, but they also have loads of liabilities, which I suspect is a financial regulation put in place so that if there was a crisis, for instance, that they would have the exact liquidity required. And since they have profit margins of 16.5%, allows the high cash flow of this business to pay a very strong dividend. However, you would like to see the quality of the balance sheet just to see that they're able to pay a dividend or that this Refinitiv deal they can afford. Whilst their short-term assets do outweigh their short-term liabilities and long-term liabilities, but not combined, they do have what would be considered to be a fairly high debt to equity ratio. As I mentioned earlier, with this possible regulation in place, I do believe that this is what makes this balance sheet look worse than it is. Regardless, this debt to equity ratio really doesn't look like much when you look at their operating cash flow and also notice the size of their cash position. However, by far the most impressive thing I like about this stock is their dividend and how much they pay it. Whilst they only pay biannually in May and September each year, and also only have a current yield of 0.87%, this is a yield that will grow faster and faster over the long term. Therefore, what you would do is buy this stock at a lower potential yield, and then exponentially, the longer you hold it, this dividend is going to compound of itself in dividend growth and therefore really boost your dividend income in the portfolio for the longer you hold it. And the value truly is in their history. They've managed to pay a dividend since 2002 and every single year except one increase it year on year. Furthermore, if we look at their compound annual growth rate in the last 10 years, which is how fast they can grow their dividend on a year-on-year basis, we can see it is 12.5%, which is already much higher than many companies listed in the FTSE 100. Furthermore, however, if we look at the 5-year compound annual growth rate, it's even higher at around 25%. Therefore, your yield on cost over the long term will start to really ramp up, and therefore it would be an excellent dividend growth income stock. And providing you have a long-term investment horizon, then this certainly seems like a winner. Although there is the red flag to this stock, and that is the idea of this acquisition of Refinitiv could fall through. And whilst the company expect it to be complete in the first quarter of 2021, this may not be the case. And if this expectation isn't maintained or completed, then likely the share price could fall further. If you'd have bought LSE 5 years ago, you would have got returns of 252.1% with dividends reinvested, which completely outperforms the market and the industry. And despite cutting back my position very recently, I will likely be building this back up over the next quarter. The next stock is a company I very much believe is in their infant stage of their growth potential. And therefore I feel that over the future, this could really be a big growth stock opportunity for investors. Recently, their share price has been dropping, and from their all-time highs, they are now down 20%. This company acts as a grocery retailer in the UK and internationally. has 15,200 employees, a market capitalization of 16.9 billion, and is named Ocado. Ocado currently has a negative price to earnings ratio, which tells me the company is currently unprofitable. So therefore we need to compare their market capitalization to their net assets, and this will give us the price to book ratio. This price to book ratio is still very high. This tells me that either they have a lot of debt on their balance sheet, or the idea that perhaps they are fairly overvalued. Regardless, as I've said before, this does mean investor sentiment's higher, and this is a good thing in my opinion. Since they are unprofitable, it would be very much ridiculous if they were paying a dividend, so in this stock I'm really going to be looking at their growth potential. And this may tell me why investors really like this stock. It's worth noting that currently Ocado only have a market share of 1.7%, and even earlier in the year Tesco had actually ruled them out of what they should really compete against, and so they're not even registered by the largest market capitalization company in the UK retailing space. According to the Ocado Investors Centre, they've managed to grow their retail revenue by 27%. This is a very strong figure, especially when the retail segment is their largest sector and is in fact profitable. Furthermore, this is still quite interesting to see, but they are developing their international solutions segment. And whilst yes, it's only currently at £1.6 million of revenue, this has the potential to dramatically increase in the future. So not only are you invested in a UK online retailer, but also an international solutions provider. This allows a lot of revenue growth streams to be acquired, and therefore does give a high growth potential chance in the longer term period. Despite their high growth potential, they are currently loss making. So what is the quality of Ocado's balance sheet to tell if they are able to survive the next few years? Well, Ocado's short-term assets outweigh their short-term liabilities and long-term liabilities, but not combined. This is in fact combined with a fairly high debt to equity ratio, although if you look at their cash position, it really doesn't matter that much. If this cash position were to be depleted and that they were remaining unprofitable for the next few years, then it may seem likely that shareholder dilution will be on the cards. But I suspect that over the next few years, they should be able to at least increase their free cash flow so they are losing less each year. Although a big red flag for this stock is that currently another firm are pushing for a lawsuit over the technology used in their warehouses. If this lawsuit is successful, it could likely sue Ocado for quite a high sum. Therefore, this risk is priced in, and it's one of the reasons why Ocado's share price has actually been dropping over the last month. This is likely the main driver for the share price to be decreasing, and in fact, if you've owned this stock over the last 5 years, you would have gotten returns of 513% without dividends reinvested, because they aren't a dividend payer. And therefore, it may be worth buying whilst it's at a cheaper valuation. It may continue to drop, and it could be an excellent spot to jump in, build that position, and consistently average sums of money into it. After all, it is one of the higher capitalizations in the FTSE 100, and it is primarily a technology stock. If you're interested in my stocks to buy and hold for life, then click the card at the top right of the video. Thank you for watching. I'm Osborne Foreman. Have a great day.